Okay, hi everyone. I'm James Harte and welcome to this Orbex Trader Education session where we're going to be looking at two of the key harmonic patterns, the BAT pattern and the ABCD pattern. Now, before we get going, let me just quickly make sure that we're all on the same page and that we understand what harmonic trading is. So, for those of you who aren't familiar with harmonic trading, harmonic pattern trading represents an advanced form of technical analysis which combines Fibonacci ratio analysis with structural analysis to help us identify key reversal areas. Now, a lot of harmonic pattern trading is based on symmetry moves where the market mirrors itself, but not always. So in today's session, we're going to look at two of the most popular patterns, the ABCD and the BAT pattern, and we're going to take a detailed look at each and talk about how we can trade these patterns. So as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically as we go along to answer them, and we'll also have some time at the end. So let's jump right in then and take a look at the BAT pattern, and we'll start with a bearish version of the BAT pattern. So you can see the BAT pattern starts with an initial bearish swing from an X to an A point. We then get a retracement higher, our AB leg, which should complete into the 38.2 to 50% retracement of that initial XA leg. From there, we then get a retracement lower, giving us a higher low into the 38.2 to 88.6% retracement of that initial AB leg. Once our higher low is in place, we then get one final push to the top side, giving us our CD leg, which completes into the 88.6% retracement of this initial XA leg, but also into the 161.8 to 261.8 extension of that AB leg. Okay, so once we get the confluence between this retracement level and this extension level, then we have the completion point for our pattern and we have the level at which we can sell. So that's the bearish version of the pattern. Let's move on and take a look at the bullish version, where obviously the parameters are exactly the same, the measurements are the same, but this time the pattern is the other way round, and we're using this pattern to buy the market instead of selling. So this time our pattern starts with a bullish swing from the X to the A leg. We then get a retracement lower into the 38.2 to 50% retracement of that initial XA leg. From here, we would then reverse higher once again, and this time we put in a lower high at the 38.2 to 88.6% retracement of the AB leg. From here, we then reverse and trade almost all the way back down to the start of our pattern, completing into the 88.6% retracement of that initial XA leg and the 161 to 261 extension of that AB leg. So this time, where we get the confluence between the retracement level and the extension level, this gives us our buying zone. Okay, so with these patterns, we're always looking for the pattern to complete at the end of the CD leg, and with the bearish pattern, that gives us our selling level, and with the bullish pattern, that gives us our buying level. Okay, so now that you're all familiar with how the pattern looks in terms of how it would be outlined in a textbook fashion, as we've seen in these diagrams, let's now move on and take a look at how the pattern presents itself on the charts, and most importantly, how we can trade the pattern. Okay, so let's kick off by looking at a bearish version of the pattern. And you can see that to begin with, I've actually labeled the swing points so that they're easy for you to spot, just as we saw on the diagram. But with time, practicing identifying these patterns, you'll find that they start to jump off the chart at you. So if you follow along then, as we looked at in the diagram, you can see that our bearish bat pattern starts with an initial bearish swing from the X to A leg. We then retrace higher into the 50% retracement of that XA leg before reversing and selling off to put in a higher low at the 61.8% retracement of that AB level, and that gives us our BC leg. So from here, we then get one final push higher, and you can see that price trades all the way up into the 88.6% retracement of that XA leg, just like we saw in the diagram. And importantly, you can see that we also have confluence with the 161.8 extension of that AB leg. Okay, so we've got our confluence between the two different Fibonacci levels. We've got our 88.6% retracement, we've got our 161.8% extension, and this gives us our ABCD completion point and the level at which we can sell. Now, in terms of how we place our stop, it's really important to highlight that one of the big advantages of this pattern is the tight risk reward, the positive risk reward that it offers. So it offers reduced risk and increased reward, because with this pattern, as we're looking to sell, essentially what we want to look to do is place our stop above the local high. So the local high is obviously the XA high, okay? So where the pattern starts and we have that swing high, we'd look to put our stop there. So if we're selling at this level here and we have our stop just here, you can see that our risk is constrained to only this very narrow margin. So we've got a really tight level of risk and opportunity for strong reward. So this makes it a really attractive pattern for harmonic traders. Now, in terms of targets with this pattern, our objective, as always, is to target 2 to 3 times our risk. Okay, so if we're selling at this D point with our stop just above, we want to measure that distance and look to target 2 to 3 times that area for our profit target. So if we look at this example, then you can see that price sells off sharply from that D point. Now, in terms of using the Fibonacci measurements themselves to identify our target, you can see quite clearly that if we target a move back down to the 38.2% retracement of that XA leg, that's giving us a roughly 3 to 1 return. Okay, so if we enter at the 88.6, our stop is just above the 100, and we trade it back down to the 38.2, that gives us a roughly 3 to 1 return on our risk. Now, alternatively, traders who like to be in the market for longer, so traders who are sort of more medium-term swing traders, can instead look to hold price all the way back down to a test of the XA low. So if we're selling at this point here, traders have the option of either banking at the 38.2, giving them a roughly 3 to 1 return, or holding the trade all the way down to test this low at the A point. Okay, so obviously you get a much bigger reward here, but the trade isn't always going to go that far. And you can see in this example that that is precisely what happened. So price sold off sharply initially from that D point at the 88.6 level, traded all the way down to just below the 38.2 before reversing sharply and trading higher. So in this instance, if the trader had been holding for a test of the low, they wouldn't have made any profit. If they'd been holding for the 38.2, however, they would have made a nice 3 to 1 return. Now, importantly, whichever way you trade these patterns, you must remember to move your stop to break even. Okay, and the best place to do this is as price retests this AB high. Okay, because if price reverses from that level, if price holds at that level rather, it's likely to reverse and trade back up. So as price retests that broken high, now termed potential support, we want to move our stop to break even to protect ourselves against any adverse reaction in the market. So if price does reverse from this level, instead of making a loss, we simply exit the trade at break even. So that's very important. Now, in terms of how we actually enter the trade, again, we have two choices. So traders can either take an aggressive approach whereby they look to sell at the level. Okay, so where we see price moving up from the C leg, so where we've got all of our other measurements in place and price is moving up from that BC higher low, and we've got our confluence between our Fibonacci levels, then as price moves up to that level, traders can simply look to sell a test of that level. Now, this is an aggressive entry, as I say, and the risk here is that price is simply going to blow through that level, not respect the harmonics, and simply trade to new highs. Now, a more conservative approach, which is one that I personally use, is where we look to wait for price action confirmation. So what that means is we simply look to look to measure how price reacts at the level and use that to gauge whether or not we should enter the market. So in this instance, where we're looking to sell, we'd be looking for the presence of bearish reversal candles at the 88.6% level to give us the go ahead to sell. So if we zoom in on this area here, you can see that the first candle that touched the 88.6% level was this bullish candle. So if we look at what happened here, price opened at this point, buyers drove price all the way up to the high at the 88.6 level, where sellers then stepped in, drove price back down, and we closed at this point here. So this first candle, which touches the 88.6% level, is showing us that there has been a strong bearish reaction in the market. So sellers have clearly stepped in. However, because the candle didn't flip bearish, because it didn't change to red, we can't count this as a reversal candle. However, the candle that we see on the next candle that we see rather is a reversal candle. So the combination of these two candles together gives us the go ahead to enter short in the market. So price trades up initially, tests the level, sellers drive price down, and then on the next candle we drive down even further and break below the low of that initial candle. So we go ahead and enter short on the close of that candle. And at this stage, we have price action confirmation, okay? So what we're doing in this instance is looking for price to confirm our bias. So we anticipate that price is going to sell off from the completion of this harmonic pattern, but instead of simply selling the level, we wait for the presence of price action confirmation to confirm our bias. So these reversal candlesticks give us the go-ahead, the confirmation that we need to enter our selling trade. And the great thing is that if we use candles in this manner to trade, then what we can actually do with our stop is bring it down even lower, and instead of putting our stop above the high at X, we can actually put our stop just above those candle highs. So we'd enter short at this level here and put our stop just above those highs. So this is another fantastic way to trade these patterns, and again, for the more conservative traders among you who like to wait for a little more confirmation and like to add extra filters to their trade, then waiting for price action confirmation is a fantastic way to increase your conviction with a trade. Now, alongside simply analyzing the price action itself, we can also look to use indicators to help confirm our trade. If we think about what we're doing here with this pattern, we're looking to trade a reversal in the market. So we want to establish that conditions are right for the market to reverse. And one indicator that can help us do this is the RSI indicator, which measures momentum in the market. So the RSI indicator measures momentum in the market and identifies it as being either overbought, which suggests the likelihood of a reversal lower, or oversold, which suggests the likelihood of a reversal higher. So if we take another look at this pattern, but this time with the RSI indicator switched on, and you can see that as price completed into that D level, so as the pattern completed, RSI had actually moved up into extreme overbought territory, signaling that we were likely to see a reversal lower. Okay? So if we think about what we've got happening here, we've got the presence of our technical pattern, our harmonic pattern, which suggests the likelihood of price selling off and reversing lower. And then we've also got overbought RSI momentum, again signaling that price is likely to reverse lower. So the confluence of these two elements gives us the confirmation that we need to go ahead and enter our short trade. So we've identified a bearish harmonic setup, and then we've confirmed our short bias by identifying overbought momentum on the RSI indicator. So this is a fantastic indicator which you can use in conjunction with the presence of the pattern to capture powerful market reversals. So we've looked at the bearish version of the pattern on the charts. Now let's quickly take a look at the bullish version of the pattern. And again, remember, all of the parameters and the measurements are exactly the same, except they're flipped on their head. And this time, instead of looking to sell at the D point, we're looking to buy at the D point. Okay, so here we have a classic bullish bat, and this is a really great example of the pattern because it shows you how sometimes these patterns can form in a slightly messy way, which won't always be glaringly obvious. But again, as I say, with time and practicing identifying these patterns, you'll find that you get better and better at picking these patterns out of the typical price movements, even in sort of messy conditions like this. So again, I've highlighted the swing points so you'll be able to see them clearly. And this time with our bullish pattern, we start with a bullish drive from X to A. We then get a retracement lower into the 50% level of that XA retracement, of that XA leg rather. From there, we then reverse higher and put in a lower high at the C point, which is up into the 88.6% retracement of that AB level. Okay, so all of these measurements we've highlighted in the diagrams at the start. So you can write these down or print them off on sheets to make sure that you're able to remember them as you're going along with your trading. So price moves up into the 88.6% level of that AB leg, giving us our lower high. Okay, so that's our structure. We've got an initial bullish move, a reaction low, a lower high, and then we get one final drive to the downside, giving us our CD leg. So we move all the way down from that BC lower high all the way down into the D point here at the 88.6% retracement of the XA leg, and then also at the 161.8% extension of that AB leg. So the charts might look a little bit messy here with all of these lines, but again, remember, all we're simply looking to do is go along and tick off on our checklist whether or not price is completing at the right levels. And the most important thing is the confluence between this 1618 extension of the AB leg and the 88.6% retracement of that AB leg. You can see they both come in here at roughly the same level. Price trades down, we hit that level, which gives us the completion of our pattern and our buying zone at D, and then from there price reverses sharply higher. So hopefully you can see here again how sticking to the measurements of the pattern can help you identify these structures even in seemingly messy conditions such as we have here. Now again, in terms of how we trade this pattern, we can either trade the level as price touches it, or we can wait for price action confirmation. So in terms of price action confirmation, you can see that price trades all the way down to our 88.6% level, and we hold at that level. We then get a few small indecision candles here. So we get what are called doji candles. This is where the body is in the middle of the wick. And then at this point here, you can see that we break higher and start to take off to the top side. So in this instance, our best bet for trading a reversal would be to wait for price to break back above that initial bearish candle which touched the 88.6. So doji candles highlight the presence of indecision in the market and suggest to us that there is a change in order flow and there's the potential for a reversal. However, they aren't traditionally strong reversal candles, and so we're far better off to wait for price to actually break back above that bearish candle high before entering the market. And then again, we're simply looking to place our stop either below the candle lows or below the low at X, and then we're targeting 2 to 3 times our risk to maintain a positive risk reward profile. Now, because we're trading a bullish pattern here and we're looking to buy the market, ideally we want to identify this pattern occurring either as a correction during a bullish trend or occurring where it coincides with a support level, such as a retest of previous broken resistance or a retest of a former price low. So in this image, you can see that we have a great example of a bat pattern forming into a clear support level at a former price low. And what we actually get here is a fantastic sort of triple bottom setup. Okay, so you can see that price has traded down into this level. We've got a clear support level, and then we have our bat pattern complete right down into those prior lows, and boom, we reverse and trade all the way back up. So this is a really great example and really great highlighting of the conditions in which you should be looking for this pattern to occur. Okay, because as we've said in some of the other sessions, we don't simply want to trade every pattern that sets up. We want to use our discretion and our analytical ability to highlight favorable conditions. So where we're looking to trade a bullish reversal, we want to see that pattern completing into a support level, because that increases the likelihood of price reversing and trading higher. So again, you should always be on the lookout for confluence with other technical factors such as support and resistance, or using technical indicators such as RSI to confirm your bias before trading. So as well as looking for structural confluence then, we can also use indicators as we looked at in that bearish version. And again, if we turn on the RSI indicator, you can see that once again we have the RSI indicator registering oversold momentum with this pattern. Okay, so where we saw with the bullish pattern price completing into the D point and likely to sell off, we saw the RSI indicator registering overbought momentum. Well, this time we have the bearish pattern completing, suggesting that price is likely to reverse higher, and confirming that bias, you can see that we have the RSI indicator registering extreme oversold momentum. So this is a really simple method or Yeah, so this is a really simple method that you can use, really. Simply looking to confirm your bias with the technical indicator, because essentially all we're looking to do is capture a reversal, and we want as strong a basis for taking a trade as possible. So where we identify the presence of a bullish reversal pattern occurring into a strong support level, and then also the confluence of extreme oversold momentum on the RSI, this really emboldens our view and gives us the conviction that we need to go ahead and take the trade. Okay, so this is a really important process, a really simple process that you can go through in terms of how you highlight these trades. Simply looking to identify the presence of the pattern into a key structural area, and then looking for the indicator to confirm your bias. So for a bearish bat pattern, we'd want to see the pattern completing ideally into a resistance level, such as a structural level or a trend line. And then we also want to see the presence of overbought momentum on the RSI indicator to suggest that price is likely to reverse lower. Now, on the other hand, with a bullish reversal pattern like this, we want to see it occurring into a big support level like we've got here. And then again, we want to identify that oversold momentum on the RSI, which indicates the likelihood of a reversal higher. So you can see that once we start to combine the indicator, once we start to combine the harmonic pattern rather with other elements, that's when we can really pick out these strong, powerful reversal levels. Okay, so that's the bat pattern then. Let's move on now and take a look at the second pattern of the session, which is the ABCD pattern. So once again, we'll jump right in and start by looking at the diagrams before moving on to check the patterns on the charts. Okay, so this is our bearish ABCD pattern. The pattern starts with a bullish drive from A to B. From there, we then get a retracement lower from B to C, which should complete into the 61.8 to 78.6% retracement of that AB leg. We then, from our BC point, we just skipped ahead there. We then, from our BC point, get another push higher, and this time, this final drive, which gives us our CD leg, should complete into the 1.272% extension of that AB leg. So this is a much simpler, much more straightforward pattern. And then again, once we get the completion of that pattern into that level, this gives us our D leg at which we can look to sell. Okay, so another really straightforward pattern, and essentially all you need to remember is that with the bearish patterns, we're looking to sell at the completion of the CD leg. So our bullish pattern then, the parameters and measurements are exactly the same, but this time in reverse. You can see that we start with a bearish swing from A to B. We then bottom out and reverse higher, putting in a retracement over our B to C leg, which should complete into the 61.8 to 78.6% level of that initial AB leg, giving us a lower high. And then from there, we get a final reversal lower. Price trades all the way down to this point, which is the 1.272% extension of that AB leg. And then again, this gives us the completion of our pattern of CD leg. And this time, because it's a bullish pattern, we're looking to buy at the completion. Okay, so that's the pattern we're looking at. That's the diagram and the measurements. Let's now quickly move on to the charts and take a look at how the pattern really shows up on the price action. And we'll kick off with a bearish version. So here you go. And again, I've highlighted these swings just to help you all identify these patterns as quickly as possible. But as I say, once you spend a couple of days, a few hours each day looking through the charts and practicing identifying these patterns, because they are really straightforward and they adhere to these strict parameters and measurements, you'll find that you quickly become very competent and confident in highlighting these patterns yourself. Okay, so we've got our bearish pattern here. You can see that we've highlighted our AB leg. So we've got our initial bullish drive. We then correct lower over the BC leg, completing into the 78.6% retracement of that AB leg, just as we highlighted in the diagram. And then from there, you can see that we reverse and trade all the way up into the 1.272 extension of that AB leg. So at this point here, we've got the completion of our ABCD pattern, and you can see that from there, we have our sell zone and price reverses and sells off. So again, in terms of how we enter this pattern, we have the same two options as we had with the bat pattern. We can either look to trade aggressively, whereby we simply enter a sell order at the level, or we can look to wait for price action confirmation. So in this example, because we're looking at a bearish version, we'd be waiting to see bearish reversal candles at the level to go ahead and confirm our short bias. So if you take a look at this pattern, then you can see that the first candle which touched the level sold off a little bit. We then got a series of inside candles before at this point here we broke down below that first bullish candle. So this would be the level at which we'd be looking to trade short with this setup. Okay, so we're waiting for price to touch the level and we're waiting to identify a bearish reaction. So we get our first reaction on that initial bullish candle where price moves lower. We then get a series of inside bars, and then at this point here we break down below the low of that first bullish candle, and this confirms the shift in sentiment, the change in order flow at that level, and gives us the go ahead to enter our short position. Okay, so in terms of stop placement then, once again, we can either look to use structural placement or we can use candle placement. So if we're entering at the level and looking to use a structure, this time it's a little more tricky because you can see that we don't have our X swing, okay? So this pattern only measures the ABCD portion and we don't have an X structural high. However, what we can simply do is look to assess the market for any local structural highs and use those to place our stop. So if we zoom out a little bit on this example and look over to the left, you can see that we had a nice swing high at that level. So in this instance, we'd simply go ahead and enter our short trade at the D level and then put our stop above that local high. And this is all we ever really want to look to do with these types of trades, is look to identify where the key structural levels are locally and hide our stops behind them, because we know that if price tests them, they're likely to act as resistance or support depending on which way we're trading and protect our stop. So as always, with our targets then, we want to aim to make a minimum of 2 to 3 times our risk. So however we choose to enter, we want to place our stop. However we choose to enter and place our stop rather, we then simply measure the distance between our entry and that stop and multiply that out and use it as a target. So if we enter here and our stop is 50 pips, then our target is either going to be 100 to 150 pips, always looking to bank 2 to 3 times risk, because again, that means that we can maintain a positive risk reward profile, which we know over time will help us yield and maintain positive results. Now, we've looked at how indicators can be used with the bat pattern in terms of filtering our trades and helping us to confirm trades, and indicators are just as effective when used in conjunction with the ABCD pattern. So we can look for confluence with indicator readings to give us extra weight to our trade bias, and as well as using indicators such as RSI and stochastics to identify potential reversals based on overstretched momentum, we can also use indicators such as moving averages to actually provide an entry signal. So for those of you who are in our moving averages session, hopefully you remember this, but for those of you who aren't familiar, the basic premise of using a moving average is that it's kind of like a pivot in the market, okay? So it's like a yardstick. When price is above the moving average, it means that the market is bullish and likely to continue higher. And then when price is below the moving average, it means that the market is bearish and likely to continue falling. So where we identify a potential sell level, so in this scenario, our sell level is the 127.2 extension of that AB leg. Where we identify a sell level, we can then apply a moving average and wait for price to break back below the moving average to confirm our bias and go ahead and enter our trade. Okay? So if we look again at this example, but this time we'll turn on our 12-period moving average. So this red line is our 12-period moving average. You can see that as price is trading up to this 127 extension, price remains above that moving average. So that confirms the bullish momentum in the market and suggests that price is likely to continue rising higher. However, once we hit that 127.2 extension, you can see that price reverses sharply, and at this point here, our candle closes below the 12-period moving average, confirming a shift in sentiment in the market, change in direction, and we can go ahead at this level and enter our short trade. So using the moving averages is a fantastic way of adding, again, some extra filtering into our trades. So if we're looking to wait for price action confirmation, what we'd be looking for in this instance is simply a candle to close on the other side of the moving average. So if we were looking at a bullish ABCD pattern, we'd be waiting for price to close back above the moving average. But here, where we're looking at a bearish ABCD pattern, we simply wait for price to close below the moving average, and then we can go ahead and set our short trade there. So this is a fantastic example of how you can integrate these harmonic patterns with other traditional chart studies, such as moving averages and RSI, which we saw earlier, to help us find the best trades and help us find the best entries. Now, in terms of how we find the best entries, as I've mentioned earlier, finding confluence should always be our main priority. So wherever we identify the presence of a pattern, we always want to see it occurring in line with other technical elements such as support and resistance or trend lines, because these add extra weight to our trade zone. And if we zoom out on this pattern just a little bit, you can see that we have a further element of technical confluence. So this time you can see that we have a really strong, really well respected long-term bearish trend line which comes in at that D level. So if we think about this in terms of a process, then what we'd be looking to do is identify the presence of our pattern. So as price is trading up here, once we've retraced from the BC level, we go ahead and add in our Fibonacci extension. We highlight where our 127 extension is. We then look to find any other confluence in the market. So we can see straight away that we can draw in this bearish trend line. And then as price tests that level, instead of simply going ahead and entering short at that level, we can wait for price to trade back below our 12-period moving average to confirm our entry point. So we've identified the presence of a key harmonic pattern. We've identified confluence with another key technical element. And then in terms of waiting to enter our trade, we've again have used another key technical element, a moving average, to act as that final filter on the trade. So this is a really great process and really straightforward, methodical way in which you can approach the markets using these patterns and using other traditional technical elements to highlight reversal levels and to also go ahead and execute your trades. Okay, so that's the bearish version of the pattern. Let's end then by taking a look at the bullish version of the ABCD pattern. I've just skipped ahead there again. Okay, so this time you can see that our pattern, as we saw with the diagram, starts with an initial bearish swing from A to B rather. We then retrace higher into the 61.8% level of that AB leg, and this gives us our BC retracement. And we have a lower high in place here. We then get one final reversal lower where price trades all the way down into that 127 extension of the AB leg. And this time, remember, the completion of the CD leg gives us our buying zone for the pattern. So we find our buying zone, and then we're simply looking to enter long orders for that trade. Now, we talked already during this session about how we can enter. So we know that we can either enter simply at the level if we're an aggressive trader, or if we're a more conservative trader, we can wait for price action confirmation at the level, looking to trade as price reverses from a set of reversal candlesticks. And then again, our stop either goes below a local structural level or we use candles. So in terms of a local structural level, then the level which stands out is obviously this support level here. So this is a really solid support level. You can see that we had 3 touches at that exact level, and each time buyers stepped in to drive price higher. So the reason why we use structural levels like this is because we anticipate that they'll be strong enough to protect our stop if price tests them and keep us in the market until a reversal occurs, okay? Because the reversal won't always occur on a dime, as they say. So we won't always see the market simply stop right on the level and then reverse. Sometimes we will get a little bit of overshoot and price will trade down. It might even test this level before reversing. So it's important that we always find these key structural levels to place our stops behind. And this ensures that we're always giving ourselves as good a chance as possible at capturing the reversal. So we looked during the bearish version of the pattern at how we can identify confluence with technical elements such as trend lines and moving averages. And again, we can also use momentum indicators with this pattern, the same as we saw with the bat pattern. So if we look at this pattern again, but this time with the stochastic indicator turned on, you can see that at the point that price has tested the 127 extension, the stochastics indicator is coming up from below its oversold threshold. So this means that price has been extremely oversold. Momentum is overstretched to the downside, and we're likely to see a reversal higher. So at this point, you can see that price has tested the 127 extension. The stochastics indicator has registered strongly oversold momentum, and then from that point, boom, we shoot to the top side and price reverses higher. So this is another fantastic way of confirming our bias in the market. Waiting to identify the presence of overstretched momentum can be a really key determinant in our success rate with these patterns. Okay, so if we're looking to trade a reversal to the top side, we want to see the stochastics registering oversold momentum, because we know that highlights the likelihood of a reversal higher. And if we're looking to trade a bearish ABCD pattern, we want to see the stochastics indicator registering overbought momentum, because we know that indicates the likelihood of a reversal lower. Now, as with all of our harmonic patterns, there is a key area that we always need to be aware of when monitoring our trade. And in terms of risk management, as I said earlier, we always want to be looking to move our stop to break even at a point that makes sense for the dynamic of the trade setup that we're taking, to make sure that if price reverses, we only get stopped out at break even instead of for a loss. And the level that we use with this pattern is a retest of that AB low, okay? So where price trades back up and retests that broken low, this is a key pivot point for the pattern. Either price is going to break back above that pattern and continue higher, or that broken low is going to act as resistance and turn price lower. So as price retests that broken low at AB, we want to go ahead and move our stop up to break even, which means that if price does reverse and trade lower, we only get stopped out at break even and not a loss. And you can actually see in this example that price did in fact fail initially at the retest of that AB low. We reversed and traded lower. We would have moved up our stop to protect ourselves anyway, but as it turns out, we wouldn't have been stopped out in this instance, because you can see price stopped just short of the D level and reversed and traded back up to go up to target. But this is a really important point, and as we discussed with the bat pattern, you always want to identify the pivot level in these harmonic patterns, which is typically a retest of the AB low in the bullish pattern, or if this was a bearish pattern, it would be the AB high, okay? So when price retests these levels, either you want to look to move your stop straight away, or you want to monitor how price is behaving as it retests these levels. But either way, the point to take away is that you need to be aware of the importance of moving your stop to break even as price retests these key pivot zones, because these are typically the make or break levels in these patterns. Now, the great thing about this pattern is that it actually highlights this example rather, is that it actually highlights one of the best ways to trade this pattern, which is looking to trade the pattern within a trend, okay? So you can see here that we have a clear bullish trend in place. We start with our low, we put in a higher high, a higher low, a higher high, a higher low, a higher high, another higher low, a further higher high, and then we retrace. So what we're actually seeing where this pattern occurs is it's occurring as a correction within a bullish trend, okay? So if we were trading the pattern like this, if this was an ABCD pattern, this would be a counter trend trade, a reversal. But where we're trading here, where the pattern is a bullish setup within a bullish trend, this counts as a trend continuation setup. And the beauty of trading in this manner is that, as we've discussed in other sessions, we're trading with the trend, which means that the momentum and the order flow is on our side, and the likelihood of catching a bigger, more protracted move is increased. So if we can look to identify these patterns occurring as corrections within trends, then this greatly increases our chance of success with these patterns. Okay, so that concludes today's session, and that's been a really dense and fast-moving session, and I hope that you've all enjoyed that. Before I wrap up, are there any questions I can answer for anyone? Okay, great. Well, I'm pleased that you all found that easy to understand and the information useful. And as I say, with these patterns, and as with all patterns, it really is just a case of spending the necessary time practicing identifying these patterns in the market, because you might often find to begin with that you struggle to identify these patterns. But if you simply print off your pattern diagrams and have those measurements next to you as you're going along, then you'll find that you'll very quickly become competent and confident in identifying these patterns, and you'll start identifying some really fantastic trading opportunities with them. John, yeah, the session will be recorded, so don't worry. Everyone who's registered for the session will receive an email of the recording. Zach, yep, same to you. Don't worry, the recordings will all be sent out. Okay, well, thanks a lot, everyone, for joining me today, and I look forward to catching you all next time. And in the meantime, enjoy practicing identifying your bat patterns and ABCD patterns on the charts. Okay, take care, everyone. Bye.